Hello and welcome to our second webinar in our Corporate Governance webinar series. My name is Vaughn Lawrence and I'm Director of Communications and Technology for PAMIC. As an organization, PAMIC is focused on providing timely education to our members about the issues that directly affect their companies. As the mandate for corporate governance annual disclosure grows closer in Pennsylvania, we want to ensure that all of our companies are well prepared for the challenges ahead. Before we begin, I would like to take some time to thank our Premium Gold sponsors for 2018. Their sponsorships allow us to offer high-quality education and exclusive benefits to our members throughout the year. Their support is crucial to the success of PAMIC and the mutual insurance industry. The Premium Gold sponsors for 2018 are Baker Tilly, Donegal, Gen Re, Guy Carpenter, Markham, Munich Re, Mutual Boiler Re, Pennsylvania and Indiana Lumbermans, Swiss Re, and Willis Re. Now I'd like to introduce our esteemed panel of presenters. First, we have Lesley Bosniak. Lesley is a managing partner of LT Analytics, a consulting firm specializing in actuarial, analytic, ERM, and operational consulting. She has 30 years of P&C, insurance, and reinsurance experience. She's a fellow of the CAS and is CERA designated, the Actuarial Enterprise Risk Management designation. Her ERM experience spans serving on her company's ERM committee, leading capital and enterprise risk analytics functions, participating in oversight and advisement of the ERM function, as well as facilitation and hands-on development of many aspects of ERM, including ERM frameworks and governance, risk appetite statements and tolerances, risk identification and dashboard monitoring, internal rating agency and regulatory capital modeling, ORSA, and scenario stress testing for clients and past employers. Our next presenter is Joe Morris. Joe is a CPA and MBA and is currently president of PNC Insurance Company Strategies, a consulting firm he founded 2 years ago based in Fort Washington, PA, that provides financial and business services to PNC insurance companies with a specialization in enterprise risk management and corporate governance. Joe has over 35 years of experience in property and casualty insurance industry. Joe has implemented enterprise risk management frameworks as an executive at 3 different PNC insurance companies and has assisted over 10 PNC insurance companies in the last 2 years with creating and implementing an enterprise risk management framework. Our next presenter is going to be Bob Whitlock. Bob has been president and CEO of the Philadelphia Contribution Ship since 2009. He's a fellow of the Casualty Actuarial Society and a member of the American Academy of Actuaries. He has been involved with enterprise risk management through his previous roles as chief actuary and chief underwriting officer earlier in his career. Bob inherited an existing ERM framework when he joined the Contribution Ship and has continued to refine and enhance the company's ERM approach since that time. Our final presenter is going to be Steve Sliver. Steve is a CPA and has been the president and CEO of Mutual Benefit Group in Huntington, PA for the past 26 years. Having begun his insurance career 42 years ago as an auditor with KPMG in Harrisburg, auditing chiefly PNC Insurance Company, he gained a broad perspective of importance of understanding and managing business on a corporate-wide basis. Through his career and prior financial operating leadership experience, Steve has worked with executive and operating leadership to develop, implement, and continuously refine enterprise risk management as a key corporate governance strategy. All of the materials that we discuss, including the video of this webinar, will be available on our website after today's webinar. If you have any questions throughout the presentation, feel free to send them to our presenters via the Q&A button on your screen. Now I'll pass it over to Lesley to begin our presentation.
Good afternoon and welcome to the second installment of the Corporate Governance webinar series. The agenda for this webinar will address not only the structure of governance and the implementation of ERM, but also actual experiences and practical considerations of putting ERM to life within an organization. First, Joe Morris will take us through a definition of ERM, overview of an ERM framework or the structure around ERM, and offer 10 activities that boards and senior management could implement to set the tone at the top regarding the importance of managing risk. We'll then hear from leaders of 2 PAMIC insurers, Bob Whitlock, President and CEO of the Philadelphia Contribution Ship, and Steve Sliver, President and CEO of Mutual Benefit Group. They'll share their experiences in developing and enhancing ERM within their organizations. Some areas of focus will be evolution of ERM within their organizations, orienting their organizations in the direction of a stronger ERM culture, formalization of ERM within their organization, involvement of the board in ERM oversight and decision-making, and some of the nuts and bolts of putting ERM to life, for example, setting risk tolerances. Then we'll open up the conversation to you and your questions. Viewers will be in a listen-only mode, so please send us your questions at any time throughout the webinar. With that, I'll turn the webinar over to Joe Morris to provide an overview of ERM. Joe?
Thank you, Lesley, and good afternoon, everybody. We appreciate you participating in the webinar today. So I'm going to cover over the next 10 to 12 minutes exactly what Lesley just indicated. I'd like to review what is an ERM, what is an ERM framework, share with you what the three components are of an enterprise risk management framework, and then, again, as Lesley said, offer you 10 activities that boards and senior managements could implement to set the tone at the top in their organizations regarding the importance of enterprise risk management in their organizations. So I'm going to start, though, with a definition of tone at the top. Now, I know this might be somewhat elementary to many of you on the call, but since that's the purpose of the webinar, establishing governance and monitoring of enterprise risk management within your organizations, it's important that the board and senior management set the tone at the top. And so I'm going to defer to COSO, who is the authoritative body on all things enterprise risk management, with their definition of tone at the top, which you see at the top of this slide. COSO defines tone at the top as the operating style and personal conduct of both management and the board of directors. So this applies to both board and senior management, and so not just one or the other. And as we apply setting the tone, we're going to use setting the tone to mean the actions, the decisions, the communications, the values and behaviors, or the omission thereof, of the board and senior management in governance, management, and oversight of enterprise risk management. So recognize it's also not doing things, not communicating issues relating to management of risk that also sets the tone. Maybe not the proper tone, but recognize it's what you do and don't do that really sets the tone at the top in your organization on the importance of managing risk. So let's turn to, so what is enterprise risk management? And I'm going to defer to COSO again. Interestingly, COSO just released their updated enterprise risk management framework in 2017. They originally issued it in 2004, and so they revised the definition of ERM in their 2017 update. COSO defines enterprise risk management as the culture, capabilities, and practices integrated with strategy setting and its execution that organizations rely on to manage risk in creating, preserving, and realizing value. So let me break it apart quickly. Culture, capabilities, and practices, that's an enterprise risk management framework. We're going to talk about that in a second. Second, it needs to be integrated with strategy and its execution, meaning you can't just manage risk over to the side. You have to integrate it with setting strategies, achieving performance goals and objectives. They all have to be worked on in an integrated fashion. Your strategy, your risk appetite, risk tolerance levels all need to be in sync to implement an effective enterprise risk management program. And finally, the whole purpose of enterprise risk management is to maintain adequate capital levels, preserve capital, realize growth in capital, but doing so in a way that you're protecting a company against the key risks of the business. So with that as ERM, let's turn to, so what is an ERM framework? And again, this basis of the definition is with COSO. It's a disciplined process to systematically identify, measure, manage, and mitigate the various risks of the organization. It's implemented by the entity's board and senior management. It's applied consistently throughout the organization to ensure that the entity achieves its objectives, but within its defined risk appetite. There are three components that you can see by the pillars on this chart. The first component is you need to establish a risk-aware culture. The second component, let me just jump back here for a minute. The second component is identify, measure, manage, and mitigate the key risks to the business. And the third component is you need a model to measure enterprise risk and to understand how one risk correlates to another risk. For the sake of today, I'm not going to spend any time on the third component. That's subject for perhaps a future webinar, but I would like to give you a quick overview of establishing a risk-aware culture and then identifying, measuring, and managing the key risks to the business. So if you're going to set the tone at the top, it starts with creating a risk-aware culture. And so in any organization, for the board and senior management to set the proper tone and create a risk-aware culture in your organization, you need to put 5 practices in place in order to do so. And so let me run through those 5 that you see on the slide here today. First, within an enterprise risk management framework, you need to establish 4 specific roles within your organization to drive risk management, oversight, governance, and execution. The first role is at the board level. You need to assign responsibility for governance and oversight to either your entire board, form a separate committee of your board, or you could also ask, for example, your audit committee to assume the responsibilities for oversight of enterprise risk management. All 3 methods are acceptable. I've seen companies do all 3, and it's whatever works for your particular board of directors. The second role is you need to form an ERM committee composed of senior officers. The CEO needs to be on it. And this is the group that will drive the ERM activities throughout the organization. The third role is Chief Risk Officer. Most small to mid-sized companies ask their CFO, Chief Underwriting Officer, or General Counsel to perform that role. Rarely is it a separate role, except if you're a large organization. But again, the Chief Risk Officer is the resident expert on all things relating to risks. Understands risk appetite, risk tolerance levels, and also has an administrative role to drive the process. Set up the meetings, make sure dashboards are completed, and make sure the board activities are communicated. It's an administrative role as well. And then the fourth role is individual risk owner. When you select the risks that will be managed within an enterprise risk management framework, every one of those risks needs to have a owner who is responsible and accountable for making sure that risk is properly managed. So there are the 4 roles, and that's the first criteria for creating a risk-aware culture. Second criteria, as you see here, if you're still not familiar with the terms risk profile, risk appetite, and risk tolerance levels, you're going to need to become familiar with these terms. They are integral to implementing an enterprise risk management framework. Risk profile is your current risk that you're willing to assume to execute your business strategy. Risk appetite is the limits of the risk that you're willing to assume. It's either expressed as the maximum amount of risk or the risks you want to avoid in executing your strategy. Both the risk profile and risk appetite are narrative statements. And then finally, risk tolerance levels are metrics, typically in areas of capital management, balance sheet strength, and operating performance. But you set risk tolerance levels in those three categories. The third component, as we heard from COSO in their definition, ERM needs to be integrated with your mission and strategies. I still see many organizations that still do not have a mission, a vision statement, strategic goals and objectives, or core values. And so it'll be very hard for you to integrate ERM if your organization still does not have these strategic documents. Fourth, to truly align your ERM goals and objectives and to have it executed, you need to align it with your performance management system and your compensation system. So, as you're evaluating the performance of both senior officers and key risk owners, is the execution of your ERM goals and initiatives a component part of that review and compensation program. And then finally, as you'll find, as you implement ERM, it is a very transparent process. All employees are expected to understand the risk appetite and risk tolerance levels of the company. The communication of the performance of individual risks are readily communicated up through senior management and the board of directors. It's a very transparent communication process about the management of the key risks of the business. So they're the five components of creating a risk-aware culture. I can assure you, you put these five things in place, and there'll be no doubt that you're setting the proper tone at the top on the importance of managing risk in your organization. I'm going to turn to the second component of an ERM framework, and that's the process of identifying, measuring, managing, and mitigating the key risks of your business. Now, here's a slide that lists approximately 26 common risk factors to most property and casualty insurance companies, placed in 5 different categories. And by no means am I suggesting that for small to mid-sized companies, you select this many risks to be incorporated within and managed within your ERM framework. Typically, companies, I'm going to say 250 million in capital or less, select anywhere from 8 to 12 of their most significant risks that will be managed in this transparent process within an ERM framework. Typically, again, companies use a bottom-up approach, create an inventory of the key risks, go through a ranking process, usually assessing the frequency and severity of each risk in order to identify those 8 to 12 that will be managed within an ERM framework. Those not included within the framework are still being managed by the company, but you're going to be doing so within the operating functional areas of your organization. Once you've selected those 8 to 12 key risks, you need some method for the key risk owner to provide a status of those risks on a regular basis that get communicated up through the ERM committee and the board of directors. And so I typically recommend some form of a risk dashboard that you see here on slide 10 of the presentation. I have no intentions of going through the slide itself, since Vaughn will be making all the slides available following the presentation, but any issue surrounding the risk mitigation strategies, the tolerance levels, the scoring of the risk, any remediation issues are typically included on a dashboard and very candidly communicated through the management and organization. It provides an ease of everyone understanding the status of that particular risk. So there are the 2 components of an ERM framework. Again, I'm not going to talk about the third, which is the modeling aspect, but hopefully then with that definition and a review of the components, it gives you a foundation of what is ERM, what is an ERM framework, and what are the key components of an ERM framework. So with that, I'm going to finish with sharing with you 10 activities that I believe that boards and senior managements should consider putting in place. And again, without a doubt, I believe that if you do so, you will be setting the proper tone at the top of your organization about the importance of managing risk within your operation. So I've broken the 10 into 2 categories. The first, which I simply call prerequisite activities, are simply 5 issues that you could put in place that really aren't related to an ERM framework, but they need to be in place for you to set the tone on ERM. So for example, the first one, company strategic plan. If you don't have these in place, we heard it needs to be integrated with an enterprise risk management framework. So that would be the first activity that I would recommend a company put in place. Second, if you don't have an ERM framework in place, again, it'll be pretty hard for you to set the tone at the top if there's not a structured process to manage risk within your organization. Third, as I mentioned earlier, you need to assign responsibility to the board, and they need to meet at least quarterly, either the board or the separate committee, to review the ERM framework and the status of the key risks. A little rule of thumb I've used over the last couple of years is if the board or a committee is not spending at least 45 minutes to an hour a quarter in implementing their governance and oversight role of enterprise risk management, my suspicions are you're not fulfilling the role that the board is expected to fulfill in its governance and oversight of enterprise risk management. And by the way, I recognize there are many board meetings that don't go 45 minutes to an hour, so I recognize what I'm suggesting here about the time that needs to be allocated to oversight and governance of enterprise risk management. Fourth, most companies have a code of conduct and business ethics, but most boards don't receive the annual certifications, don't review them, don't review the exceptions and make sure they're resolved satisfactorily. Again, making sure that the board has oversight of conduct and business ethics is an important prerequisite activity to set the tone at the top. And then finally, I mentioned this a couple seconds ago, if you do have incentive compensation plans in place, cash bonus plans, for example, in your organization, are they linked to company performance? Are they linked to your ERM framework? And then finally, do they have clawback provisions? Meaning, if subsequently the company, for example, has to restate earnings, does the company have the legal right to take back a cash bonus payment made previously that otherwise wouldn't have been paid if the adjustment was made in the actual year? So let's call those the first 5, and they're what I would call prerequisite practices to setting the tone at the top on enterprise risk management. The final 5 all relate to ERM activities. So first, or number 6, would be communicate your risk tolerance levels and risk appetite statements throughout the company. Make sure all employees understand what your acceptable levels of risk that you have selected consistent with the business strategy. Make sure all employees are aware of your risk tolerance levels and risk appetite statements. 7, make sure as a board member you're reviewing these dashboards quarterly. Number 8, I mentioned there are 8 to 12 key risks that are being managed within the ERM framework, but typically there's 3 or 4 or 5 most significant risks that the board should get a full briefing on sometime throughout the year. It shouldn't just be reviewing dashboards. They could be investment portfolio risks, they could be catastrophic property exposure in the reinsurance program purchased to protect the company. It could be cybersecurity, which is now part of an NAIC Model Act that will require board oversight and governance. So any of 3 or 4 risks that the board should get a full briefing on how well the company is doing in managing and mitigating those top risks. 9 is making sure that the controls and risk mitigation strategies are being tested on a periodic basis. And then finally, number 10, there are still companies that don't prepare budgets and forecasts, believe it or not. And again, part of the whole ERM is eventually modeling the performance of the company. So it clearly starts with, again, I recommend at the outset, just do a 1-year income statement, balance sheet, and capital adequacy ratio forecast, a base level performance. And then once you get to that point, ultimately, you're going to want to stress test that forecast to make sure that you understand what happens to your capital adequacy ratios when certain risks happen to occur. But again, I recommend from that perspective, start with a single year and forecast it all the way through to balance sheet and capital adequacy ratios. So again, I'll take a step back. These are 10 practices or activities that boards could put in place working with their senior management team. And without a doubt, you would be setting the proper tone at the top that managing the key risks of the business is just important to your company as growing written premium and producing combined ratios under 100. So I'm going to stop there. Be happy to take your questions during the Q&A. So Lesley, I'm going to turn this back over to you at this time.
Thank you, Joe. Next, we'll hear from Bob Whitlock, President and CEO of the Philadelphia Contribution Ship. Bob?
Thanks, Lesley, and good afternoon, everyone. Thanks for joining us. Let me start out by thanking both Lesley and Joe for inviting me to be part of this webinar. ERM is something that we take very seriously at the Philadelphia Contribution Ship. You know, when you're managing a company that is, in our case, 266 years old, you think very seriously about perpetuation and what can get in the way of that. And I know many of our PAMIC member companies are in similar situations. Our members have been around for a very long time, and that longevity in itself is an asset that we need to protect. And I'll suggest that the very thought process of determining what could get in the way of perpetuating our companies is exactly how developing an ERM process can begin. It's also a good starting point for prioritizing risks. Those events that, if they occur, could put you out of business are clearly the ones that should get the most attention in developing risk mitigation strategies. So if you've ever thought about what could get in the way of your company's success and have done something about it, you've already started enterprise risk management. Here's a simple example. If you buy reinsurance because either a very large claim or a significant CAT event could put your operation at risk, then you've implemented an ERM approach. In that case, you've identified a risk to either earnings or surplus, and you've put a risk mitigation measure in place. That's ERM at its core. In our case, ERM has been an evolution with continuous refinements and improvements over time. The company took its first step in formalizing its approach all the way back to 2006, when our board established a risk management committee. That step put the responsibility for establishing the risk management environment and monitoring risk management activities squarely at the board level. And so with oversight at the board level, management then had the responsibility to identify, prioritize, and mitigate risks. For risks that we've identified, we have implemented a scoring process to prioritize risks where they are evaluated on 2 different dimensions. First, what's the likelihood that the risk will occur? Second, what's the impact of the event if it does occur? The combination of those 2 factors determines the priority level of the identified risk. And of course, high likelihood, high impact risks get the most attention. We categorize the top priority risks as, quote, managed risks, those that we actively manage and report to the risk committee on a quarterly basis through a dashboard, much like the example that Joe showed earlier. The remaining risks are categorized as, quote, monitored risks. They have a lower priority, and so, as the name suggests, are monitored for change in risk level, but did not rise to the level of active management and direct board involvement. We do report on monitored risk to the risk management committee, but on a much more summary level. By the way, that scoring and prioritizing is not static. Because conditions constantly change, we review the risk scoring and prioritization on an ongoing basis. And as a result, priorities have changed over time. I think the most challenging thing we introduced, but arguably is the most important change in the evolution of ERM at the contribution ship, is the development of risk tolerances for our managed risks. In developing risk tolerances, you first need to agree on a reasonable way to quantify a risk, and then ask people to determine how much risk is too much risk. And that's not always an easy question to answer. It can be very subjective. Every person has a different risk appetite, right? And so my advice when developing risk tolerances is to avoid open-ended questions on the topic like, how much cat risk are you willing to take? While that may entice robust conversation at the board table, it may be difficult to get consensus. We found it's far better for management to suggest a reasonable, specific level of risk as a starting point and ask directors to react to that. Often this is really a gut level decision with no specific right or wrong answer. But if you start off with a suggested tolerance, you can get a sense of how directors react. If they're squirming in their chairs, that may be just too much risk to take. If they don't blink, maybe there's room to take on more risk. Remember, there's usually a cost associated with risk mitigation. And so finding that balance point is often an iterative process. Coming up with a good risk measure sometimes requires some creativity too. For example, one of our managed risks is employee turnover. As a relatively small company, each employee takes on added importance because many of us don't have the luxury of staff redundancy. And so turnover can be very disruptive. I suspect many PAMIC members can relate to that. In order to measure prospective turnover risk, we developed a mechanism where every position in the company is scored on 3 dimensions. Criticality, that is, how important is that position? Vulnerability, how likely is it that the incumbent may leave? And succession, is the successor identified? And if so, when will they be ready to step in? The combination of those factors produces a risk score for every position. And our risk tolerance measures the percentage of employees with high risk scores with the intent to keep that percentage below a certain threshold. So sometimes you have to get creative. I mentioned that the development of risk tolerances was arguably the most important step we've taken. And I say that because once that risk tolerance is established, you have a tangible measure that you can manage to. And the levers you can pull to impact that measure become operational in the development of strategies and plans and in how you manage the business day to day. I think a good example in our case is catastrophe risk. Our cat risk tolerance states that we want to keep the probability of the loss of a certain percentage of surplus from a cat under 1%. So armed with that tolerance and the output of our cat models, we can manage exposures, we can manage agency activities, and buy reinsurance to stay within that tolerance. Adhering to risk tolerances is an important way to drive sound risk management practice throughout the organization and develop a risk management culture. And I think that's brought the greatest value to the company. That is to keep risk management in the front of the minds of staff and make it part of what we need to accomplish every single year. In the case of cat risk, it's also brought value in our discussions with reinsurers about how we are mitigating our cat risk and so theirs. Another suggestion I would have in developing a risk management culture is to get as many people in the organization involved as possible. The more people that are directly involved, the greater the likelihood that there will be buy-in on what needs to be done to mitigate risks. If it's limited to only a few people, then a risk management can be thought of as, quote, someone else's job. In our case, we've established an internal risk management committee, which is populated by middle managers and staff from every department. They are charged with identifying emerging risks or risks that have not risen to the level of the framework overseen by the board and developing mitigation strategies for those risks. It's been a very effective way to drive that culture throughout the company. So I'll finish with this. Managing risk is what all of us do every day as leaders of insurance companies. So conceptually, it's not new. but developing a more structured and systematic way to identify, mitigate, and track risk creates additional focus on the things that can get in the way of our success. It is simply good governance and is consistent with our fiduciary duties to our members. But it's also getting more attention at the regulatory level in the form of risk-focused examinations, and eventually in the corporate governance annual disclosure that's coming our way. So if you haven't started developing an ERM framework, I'd suggest that doing so will not only help you in managing your risk, but will also help in the regulatory world as well. So I'll stop there. Thanks for listening, and I'm going to turn it back over to Lesley.
Thank you, Bob. Next, we'll hear from Steve Sliver, President and CEO of Mutual Benefit Group. Steve?
This is Steve Sliver, and I do apologize for my technology glitch that kept me from participating this afternoon in our important webinar about enterprise risk management. But I thought I might add a few pertinent thoughts via this recording that I think are important to consider from my perspective as it relates to the topic of enterprise risk management. The first thing I do want to go back and emphasize Bob Whitlock's opening comment. I think he hit the nail squarely on the head when he indicated that regardless of the lack of formality you may have as far as some kind of a documented enterprise risk process, you probably are already doing a lot in that area. And no successful company over time can be around and survive without managing risks effectively. So I don't think if you're one of the members here thinking about getting started that it should be a daunting task. I think it's a matter of more pulling your thoughts together. The second thing, if you look at Joe's slide, which was slide number 7, I would add the following to the illustration. I would encircle the ERM structure and include within the circle the words mission, opportunity, strategy, core values. I think, and this has really helped inform me, I think, but I think risk follows mission and strategy. It's what we'll attempt to do that really informs the risks that we're going to have to manage. And I think that's a critical thought to keep in mind, because sometimes I think we get all tied up in knots thinking about risk, but we haven't really fully thought about the fact that, geez, the risks emanate from what it is we want to do. And then finally, the other thing I would add to the discussion today is that I think that the point of emphasis around a corporate-wide engagement with the enterprise risk process, from board through management all the way down through the rank and file of the company, is really critical. And I think particularly maybe in our industry more than some others. If you think about a lot of other industries, pricing and risk acceptance are things that happen at a pretty high level within the organization. But if you think about insurance, an underwriter, a claims adjuster, each and every day in carrying out their function are making pricing decisions around risk, and therefore impacting the level of risk, the quality of the risk that the company will undertake. And sometimes those numbers are fairly large as far as the exposure values. And the same thing's true of a claims adjuster. I mean, there is a claim and there's a purported risk, but we're taking it on through the adjustment process. We're pricing it in a strange way to say it. And so with our organization, with our industry function, I think it really is important for people lower in the organization who have much greater responsibilities and interaction in risk management to understand how what they do impacts the overall enterprise risk and health of the company, and vice versa, how the other aspects of the company, the other risk aspects of the company correlate with what they do. So again, I thought I'd add a few thoughts there that I hope will be helpful to you as you're either building an ERM methodology and executing it, or refining what you've already had. And I do, again, one more time, apologize for the technical problems, but certainly appreciate the opportunity to participate even in this way. Thank you.
So we did have one question come in. Are there samples of an ERM plan that are available for review? And if so, where can we see it?
So Lesley, this is Joe. I'd like to take the first crack at that, which is I'm not aware that anybody has actually published any form of an enterprise risk management framework that's available, particularly for small to mid-sized companies. Large companies that qualify for ORSA, file their ORSA reports with regulators, but they're confidential, proprietary, and not made available to the general public. So today, I'm not aware of any place that a management team can turn to get a sample ERM framework. Again, my suggestion would be start with your reinsurance brokers, ask them for material that's available. But for the most part, regulators haven't promoted examples or frameworks. Rating agencies haven't done so either. So that's the challenge for small and mid-sized companies. There isn't a authoritative sort of best practice approach as to what an ERM framework looks like.
Joe, I've seen the same thing. I mean, COSO is a great resource, and RIMS, rams.org, is also a good resource just to get some background and some guidance. But yes, I've seen very few actually ERM frameworks published. I think when we were researching frameworks, this was probably about 5 or 6 years ago, we did do a search on the web to see what we could find, to see if we could find some samples. There were a few that were out there. They're not insurance related. I can definitely say that the Reserve Bank of Australia, Queensland government, and actually J&J, Johnson & Johnson in the United States, I really liked the structure of what they had put together. Those are the only 3 that I have seen. And yeah, you're right. I agree with Joe. There's no set way to set up a framework. It's something that fits well within your organization. Okay, then why don't we continue with questions? Here's another question. What do you think of heat maps?
Bob, maybe we could start with you. Do you use a heat map in your ERM framework?
Not specifically within the framework. I mean, certainly within some of the specific risks that we manage, what comes to mind immediately is cat exposure. So we certainly can map exposures down to the zip code and census tract level, and we do that to get a good visual sense of where our exposure is. But that's certainly within the specific risk management, not in the overall framework.
I see. So from my experiences, I have worked with companies who have used heat maps, and essentially, Bob described during his remarks that he ranks risks with a likelihood and an impact. I use the terms frequency and severity. And so you could set up your heat map to reflect all your risks on a heat map. Again, I find that it's more of a visual tool. It helps some members of management and board of directors to visually see how one risk ranks versus another risk. It's a good visual tool, and if that works effectively with your management and board of directors, I would recommend that you include that particular tool in your enterprise risk management framework. Again, it really depends on, would your board members and management find it a good tool to relate one risk to another risk.
Thanks, Joe. Thanks, Bob. We have another question about ERM with respect to thoughts about where it could reside within the governance of an organization. audit committee or some kind of governance committee. Do you have any thoughts on that? And Bob, what kind of thought process did you go through to land on where ERM from a reporting and oversight standpoint should sit?
Sure. Yeah, I mentioned in my comments that in our company, the responsibility is placed squarely at a separate committee of the board, the Risk Management Committee, that ultimately reports to the board on these matters. But that said, part of our risk evaluation process identifies which board committee has primary responsibility for monitoring that particular risk. So for example, the audit committee is responsible for oversight of loss reserve risk. So the point is that the general oversight within the framework for ERM responsibility rests with the risk management committee, but specific oversight can be delegated to different committees of the board depending on the subject matter. Lots of models to follow here. I think the point is, though, that having that responsibility at the highest levels of the company, at the board, whether it's full board or committees or however you choose to structure it, that creates that focus and shines a bright light on this very topic so that that tone from the top can be disseminated throughout the organization.
Any other feedback, Joe?
Well, Lesley, as I mentioned in my remarks, I've seen it actually equally in all three areas, meaning the entire board does not delegate it to a committee. I've seen it where the audit committee has assumed responsibility, and then in the contributions case where it's a separate committee established by the board. Again, all three are acceptable, and so it really is more what suits the particular board, as Bob mentioned. So I haven't seen ERM fall under the nominating and governance committee in any company I've worked with. That's not to say it doesn't fit there, but again, I would say it's up to the particular board to decide which method they want to govern, monitor, and oversight the ERM framework.
Okay, thanks, Joe. Here's another question. Do you have a good example of bottom line or marginal impact of poor ERM?
Lesley, I'm not sure I understand the question, but I think it's a good question because, particularly as Bob mentioned, it's now part of the risk-based financial examination process, and so during your next 5-year exam, your regulators will be assessing your ERM activities, your governance and oversight of ERM, and so interesting though, I haven't seen it be reflected in any financial examination report to date. I do understand, though, by the way, that regulators are beginning to send, I'm going to call it, confidential inside letters to the management team, even about ERM and governance, even if it's not in the actual financial examination report. But with that said, the only thing I could offer to the group is the concepts that I described earlier in the presentation of creating a risk-aware culture and the risk identification process. If they are not in place in your organization, you might be more in danger, let's say, of being at the low end of compliance with expectations relating to ERM versus those that have those practices in place, more than likely, are implementing all of the best practices that exist for managing the key risks of your business.
Okay, the only example that really comes to mind with this question, as far as kind of the implications of poor ERM that you can kind of really measure and see, is something like AM Best and their rating assignments. And the ratcheting up of the rating with BCAR as their starting point for all of the different features of the operation, one of them being ratcheting the rating up or down with respect to the risk management practices. Let's continue. We have another question on cyber. How do companies position the state cyber requirements within ERM and respond to state requirements? Is that something that that this small group would be able to offer feedback on?
So I'll start, Bob, but maybe you have some specific ideas relating to how contributionship does it. But with the NAIC just passed the Model Act on information security. If any of you have not had a chance to read the Model Act, I'd encourage you to do that, because part of the Model Act requires the board to have oversight of risk management, to conduct a risk management assessment, and to have a cyber policy and program in place. And the board will have to certify to that on an annual basis. Again, once the Model Act is passed and adopted in Pennsylvania or your particular state. And so clearly, cybersecurity has to be part of your enterprise risk management framework. For most companies, small or large, I would think most of you will identify it as one of your top 8 to 12 risks, regardless of the influence of the regulators. And so as you get familiar with the NAIC Model Act, as you begin implementing the ERM framework, I think you'll see those two coming together, and many of the risk mitigation practices and techniques that the Model Act requires will be the practices you're going to count on in your ERM framework in order to mitigate your risk from cybersecurity.
Yeah, the only thing, this is Bob, the only thing I would add to that is we're sort of following the state requirements as they're evolving again with the Model Act. Clearly, cyber risk is something that has reached our managed risk level. We've attacked it pretty much on a technical basis, making sure that we have the technical expertise and tools available to detect penetrations and those sorts of things. But the development of the Model Act is something we're going to be watching very closely to see how it impacts how we need to treat it from a governance point of view.
Thank you, Bob. Here's another question on more common enterprise risks. What do you see as the most common enterprise risks that a medium to small size P&C insurer face? Bob mentioned reinsurance for CAT as one example. Any thoughts, Bob?
Yeah, I mean, I think CAT is one example. If you sort of step back and you say, what are the things that could cause impairments in either earnings or surplus, you're going to get a short list pretty quick. So investment risk, CAT risk, all the things that are going to affect your income statement and balance sheet. So those are the ones. I mean, Joe put up a list of many that were up there before, so that may be a list to choose from to start with. But I don't think you have to look very far to say what types of things are going to impact our financial condition.
Joe, any additional thoughts?
Yeah, no, I would agree with Bob. That is, I did share this slide that I just put back up. Again, more than likely for most small to mid-sized companies, it's going to be pretty hard for you not to identify some, interest rate risk, loss reserve risk, pricing risk, catastrophic event risk. Some of the risks are indicative of being a property and casualty insurance company. But really it's up to the individual company to really decide, and as Bob mentioned earlier, and to really go through a risk evaluation process, assess the likelihood of the risk happening, assess the impact to the company should it happen, and the top 8 to 12 risks will naturally move to the top, and they're the ones that you're going to need to manage in a very disciplined, transparent way up through the board of directors. So it really is a unique risk evaluation and prioritization process that each company has to go through as part of this process.
Thanks, Joe. The two that come to mind for me, you know, being an actuary, one of them that I think about is the sophisticated modeling that is taking place today with larger data sets and the analytical capabilities that that requires. And does that cause an unleveling of the playing field between larger carriers that have greater capability, just, you know, some of it may be just geographic as a result of being in a location where they can access those with expertise to do more complex modeling. But, you know, also just, you know, small companies, you know, do they have, is that something that they can include in the analytics that they build within the organization, given that they are a small organization? That's one thing that I think about. Another thing that I think about, which just doesn't just face small to medium-sized organizations, it's across the board, is really cyber risk. You know, one click of a link, a bad link, you know, could compromise any organization and their network. And I know in my past life, in the management team of a reinsurance company and on their ERM committee, that was something that was front and center focused to us. What can we do to make sure that we protect our organizations such that there is no, you know, breach of our networks, particularly at very busy times of year, high quoting times of years, and also, you know, what do we do from a claims perspective if, you know, we have a situation where, you know, we can't pay our claims because we have some kind of breach. Those are the two that I think of in particular. Next question. You know, this is a question that I would direct to Bob. So looking back at the path of your company and that it took in formalizing ERM, how would you advise a company that's just starting out to develop ERM? Where would you recommend starting?
Well, you know, I think the path that the contributionship took has worked reasonably well. So my recommendation is to begin first by formally placing responsibility for EM oversight at the board level in whatever manner that the board sees appropriate, whether it be full board committee or another way. I mentioned before, in our case, we established a separate risk management committee, but it doesn't have to be that, obviously. Once that oversight's established, I would suggest getting key players in the company in a room to simply brainstorm on identifying a list of risks that need to be prioritized. And I think you'll find that once you get started brainstorming, there is not going to be a shortage of risks that you need to tackle. We're in the business of managing uncertainty, so it's likely that those in the room will already be in that mindset and will have plenty to contribute. So armed with that list of risks that the company faces, you can begin to prioritize and identify those that need the most attention, and you'll be on your way. I think once you have a sense of the risks and priorities, then it will become clearer how they fit into whatever framework the board may choose to oversee and monitor the risks in the organization. But I think, again, it all starts with establishing that oversight at the highest level of the organization, at the board level, and that's going to set the tone for the organization to follow.
Lesley, I'm back in case you're looking for me.
Okay, thanks. Just to follow up on Bob's responses, yeah, I mean, a risk identification would be kind of very high on my list as far as, where to focus early on. It's a place where, you can also get kind of more bang for your buck and really understand, which risks are high priority, what your organization is doing about them, and what more needs to be done. So, if there is something that really needs to be dealt with immediately, risk identification can help with that. And Bob's thoughts on when in his remarks on starting the discussion of kind of roundtabling all aspects of the organization, claims, underwriting, compliance, actuarial, all aspects of the organization, that helps to start building the culture and making people aware of the risks that exist across the organization. So yeah, I've experienced very similar things to what Bob has done and Bob has experienced. Any other feedback on this question?
I don't have any, Leslie. I agree with both you and Bob that, and Bob mentioned it in his first sentence of his comments. Companies and managers have been managing risk their whole career, and so it really starts with the risk identification, prioritization, and management. So if you're just getting started, manage risks, and then put the governance and oversight process in place to communicate the results of those risk management processes.
Okay, well, I believe our time is up, so we will bring this webinar to a close. And I do see a couple more questions out there, so we'll definitely follow up with responses to those webinar questions. Thank you for participating in the webinar today, and look for future PAMIC webinars. Thank you.
So we hope that you guys found the presentation valuable. And if you have any other questions after we sign off, feel free to email me or any of the panelists. My email is vlawrence@pamic.org. All these materials will be made available, and I'll make sure to put up contact information with them for our panelists, just so that they can offer their insights to anybody who needs to get their questions answered. We're going to be hosting another webinar on February 22nd covering succession planning and talent management, hosted by Dr. John Park of Baker Tilly. It should be a great webinar for all of our members. Again, I want to thank our premium gold sponsors for making this event possible. We truly value their support, and we hope to see you guys all back on February 22nd. Thank you guys so much.